Hello, hi, good morning.
Good morning, Professor.
How are you, Subrat?
I'm doing good, Professor. How are you?
All good. So, can we start? I think we could, right?
Sure, sir.
Okay, great. So, Aniket, if it's not too much of an ask, can you keep your camera on, please? So, in our last few sessions, what we discussed was we discussed about the fraud part of fraud and risk analytics. And today, what we're going to talk about is the risk part of it. Because as important as fraud detection and prevention, equally important is the objective at the CEO and sometimes at the board level also is to mitigate risks. Okay. So while we say fraud management, we also say risk mitigation. Okay. Why do you think we don't say risk elimination?
Because risk can never be eliminated as long as we have to do the business.
Okay. And why is that so?
Uh, because the very act of knowing the customer better opens the channel for sharing of information. And
Mm-hmm,
whenever there is sharing of information, there is always a chance that that information could be misused, leading to a fraud.
mm-hmm.
So, since a business always will look to uh, know its customer better, it cannot stop itself from actually collecting information. And if the information is getting collected, there is always a chance of fraud. So, both the business as well as the customer, they need to exercise caution.
Right.
So, risk will always be there. Risk can only be minimized.
Yeah. Great. Aniket, your views? Aniket, are you with us or are you at the beach? Yeah. Hello. Okay. Aniket looks like he's at the beach. Yeah. I would then request you to please be at the beach and not be here because if you're here, you need to be here. Yeah, Aniket. All right. So we don't eliminate risk because we got to do business as well. And if we have to do business as well, we have to make sure that we do it prudently. So we will never be able to eliminate risk, we will always be able to reduce the risk that we are talking about because by reducing risk, we would have managed our financial as well as our organization health better. And that's what we want to do. So the risk manager will have one objective, which is to minimize risk or manage risk within the organization up to a certain level. There'll be a risk score given to him or her. And for the fraud, they'll say fraud levels, whatever kind, fraud levels to be at its base minimum, and that's usually in both cases, a single digit target is given to the management. And while the CEO has it, the risk is board of risk governors will also have that objective of minimizing risks. Yeah. So let's try and understand what is this piece of risk management and how does it work? And especially we will talk from the lender point of view, which is the bank. Now, in the case of the bank, the assets and liabilities are completely opposite to the assets and liabilities, how we look at things. Yeah. So in the case of a bank, there is a different kind of a balance sheet. So you have asset products and you have liability products. So when you have, like a brand manager in FMCG, you have a product manager here, and they manage loans or credit cards or even liability products. And the popular term for liability products is current and savings account, or a manager called as CASA, which is current and savings account. This is the most important area that banks want to focus on, because this gives them non-interest income or fee income. For example, if you didn't maintain a minimum balance in your account, then the bank will charge you a fee, and that is easy to charge. There's no effort being done at it. Suppose you ask for a printed statement with a stamp of the bank, then obviously they're going to charge you for it nowadays. So those are your, fees that the bank is going to look at, and the bank is happy with that because it comes easily, as opposed to a loan given and then you have an interest income which is on this side of the balance sheet. So an asset for us, which is our balance in the current and savings account, is a liability for the bank, because they have to pay you back if you close the account, or if a fixed deposit matures. A loan for us, like a loan on a credit card or a loan that we take, is an asset for them because they earn income out of that, and that is the interest income that they make. So it is slightly different in terms of how a bank classifies a asset versus how it classifies a liability, and which is completely opposite to how a normal individual customer would do that, or a corporate also for that matter would do that. So there are four types of risks that are faced by by banks. There are four types of frauds. Shubrat, any idea what those four types of frauds are?
Uh, Frauds, as in the one we learnt about in the first session
Yes.
under money laundering.
So
Uh,
money laundering is one type of fraud,
yes, money
which
laundering.
has which has
Yes,
sources, placement, and layering.
yes, right,
What is the second
right.
type?
Fraud. Mm, One was phishing.
Hmm. Correct.
Uh,
Third,
Phishing. Then law theft of identity.
identity theft or theft of identity. Correct. Then fourth,
Uh, Fourth is mm,
data compromise.
data compromise, right?
Yeah. So can
And
I say insider threats?
insider theft as well,
Insider
right?
threat, insider threats. Yeah. So can I say all these types of frauds are a part of fraud risk?
Yes,
Correct. So fraud risk,
yes.
we understand very well. Fraud risk is a risk committed by a fraudster in this one of these four styles.
Okay, okay.
Yeah,
So will it be correct to say that whatever we learned in the first two sessions, that is a subset of the risk eventually?
correct, correct. Which is therefore linked with risk.
Okay,
So therefore, a lot of our people say, let's do fraud management, and that's incorrect because you're only doing part of the management. What about risk management?
right,
Yeah, and hence fraud and risk are nowadays correlated.
right,
Yeah, because one of the risks is fraud risk.
right.
Yeah. What is credit risk?
Uh, Basically, customers not fulfilling their credit obligations.
Yes, absolutely. Customers not fulfilling their credit population. So you're supposed to give even a minimum payment on a credit card, you're not paying it.
Right,
Or
right.
if you're
Defaulting
supposed to
on their
give an
loans and credit cards.
correct, if you're giving your EMI, then you're not paying it. Okay.
Right,
And that is your credit risk because non-payment is a loss to the bank.
right.
Okay. So credit risk or credit loss is a part of their business. True or false?
Yes,
Yes, yeah, where we say we cannot eliminate risks, and therefore credit loss can never be zero.
right, right,
Okay. So credit risk is a nature of business. Some are bound to happen, but it can't be a lot.
right.
Okay. Now, what's operational risk?
Uh, Risk that arises due to threat to the IT systems of the company.
Yeah,
IT
only
system
IT.
risk. IT as well as other processes of the organization as well.
Okay. So it could be HR,
Yes, it could be HR as well.
it could be ops,
Right,
it could be finance.
right,
Suppose you
right,
don't have backup plans. Okay.
right.
Is that a risk to the position? Yes, it
Yes,
is.
definitely.
It is, yeah, it is a
Yes,
risk to the position. So operational risks occur because of the operations of the organization. And because it
right,
is operations, it is largely driven by the chief operating officer that looks after ops and IT.
right,
Okay, and they will drive it because it has to be from, because that's where most of the operations happen in terms of volume and value.
right,
Nowadays, everything is centralized with the back office, and that back office is operations.
right, right,
Yeah. So credit risk, fraud risk, operational risks. And suppose, for examples, in the management meeting, they say, we need to invest in cloud because if we don't get a backup on our data, we are vulnerable to that risk.
right.
And that will fall under credit, fraud, or operations.
Uh, if you don't have a backup, you're saying,
Yes. And therefore, we want to invest in cloud. That's the business case proposal for
yes,
cloud.
it falls under mitigation of operational risk.
Correct. So it is, so one of the strong points for need is, first point on top is, by this, we would have addressed operational risks. And now you
Right,
see in terms of the priority zone, how important it becomes. So data
right,
backup, earlier we used to invest in physical servers.
right,
And the investment in physical server was huge, taking it out of the revenue. And this was one of the
right,
key reasons why you had to do that. And why you had to do that? Because it was also monitored by the regulator.
right,
Okay. So
right.
operational risk, fraud risk, credit risk. Well, and the fourth one is market risks. What do you mean by market risks? Risk because of the
Uh,
market.
right. Due to fluctuations in the economy.
Okay. Any classic examples?
Uh, Classic example could be when the first wave of COVID hit and the economy was going through a bad time. Then at that time, many companies, especially IT companies, they had uh, loss of customers, due to
Correct.
which they had to lay off people. They had to cut down on their spending. So that could
And
be one
yeah,
example of market risk.
correct. And plus, moreover, they were not able to this thing. A lot of customers were not able to meet their EMI commitments.
Right, 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 right.
And hence,
Yes,
that was a problem because it came very suddenly.
right, right. And even RBI also gave a moratorium
Loan,
period back then.
yeah,
Yes,
they gave a loan holiday for 3 months, right?
yes, yes.
And US gave a lot of that, because of which you have the problems that they were happening last few years of a possible recession
Right,
because of
exactly.
the stimulus package they gave to everybody.
Right,
Yeah. And so market risks are risk because of COVID, because of the Fed not in continuously increasing interest rates, because of
right,
geopolitical stress around the globe, and all these are creating risks in business.
right,
So when the risk department got established, the risk department's main function years ago, say 20 years ago, was only credit risk. So they classified a person, they got a person, and his or her job would be head of credit risk.
right,
And okay, and then there was this person only primarily credit risk, but he would also manage these other type of risks. But one
right,
person. Then it became credit risks and other risks. A separate person got appointed to manage fraud operations and market.
right, right,
And then what happened? You had credit risk and fraud risks. And then other risks were these, because operations was jointly taken on by the operations head. So you had
Right.
credit risk with fraud increasing, you had operations and market together. Now they have credit risk, fraud risk, operations risk, and market risk separate. So you have four verticals to lead the four functions because risk in the last 4 or 5 years has increased.
Right.
Yeah. And now when you classify risks, you want to classify risks as what is the amount that you've lost because of credit, fraud, operations, and market. You have to classify them under these four or whatever other, but these four for sure.
Right.
Okay, so loss, which risk would be contributing the most to the loss in the organization?
Uh, I think for a financial institution, credit risk would be the biggest risk, along with fraud risk. And for like non-financial institution, uh, fraud and operational risk will be top two risks.
Okay, so which is the most number one? You
For a
see
financial
credit.
institution, it's credit risk, and for
Uh-huh.
non-financial institution, I would say fraud risk.
Okay, all right. We will try and answer this a little later, but yes, okay. So obviously these are the four types of risks. Now, this is why we cannot eliminate risk, which we spoke about a little bit earlier, because you want to balance both. You want to balance risks and returns. And there's this talk that they said was more the risks, more the
More the
returns.
return. Yes.
Correct? And therefore, if you take more risks, you get more returns. Right?
Right. Right.
And therefore, you cannot eliminate risks, but you have to manage risks prudently. So risk
Right.
has become a management function now. And because risk has become a management function now, they have to closely work with strategy.
Right.
Yeah, because if your strategy is prone to risks, then you have to be very careful of what you are getting into. But if your strategy is not going to be risky, then it's a great go ahead. So you need that risk verification on your strategy. Okay.
Right.
So risk is a very important function that has gone up in the last few years, particularly last 5 years.
Right.
So this is the case study. We'll come back to this in a little later, but let's try and understand the concept here of bill discounting. So money laundering, we know how it occurs, but how does bill discounting occur? And how does this bill discounting occur? It occurs because of these kinds of things. So obviously you have a seller who's selling goods to the buyer here. What does the seller then do? After I've sold goods to the buyer, I am going to draw the bill on the buyer. So I'm going to say, this is my invoice. The buyer will accept the invoice. So that's the transaction between the buyer and the seller. Sells goods to the buyer, seller draws the bill on the buyer, and buyer will accept the bill. Okay. Now, what is the seller going to do? The seller is going to present this to the bank.
Right.
Yeah. The bank acts as a guarantor. And for that, the bank will charge a fee on behalf of the buyer. What will
Right.
the bank do? The bank will validate the bill and the invoice, and the bank will credit the amount to the seller. So according to the terms of the payment. So the bank will pay the first 50% or whatever that is to the seller. The buyer is not yet paid to the bank as yet. On
Right.
the day when the transaction closes, the bank is going to receive all the money along with fees from the from the buyer. And that is called as bill discounting, also called as guarantee, letters of guarantee and letters of discounting.
Right.
And that's how the bank, what is the benefit of the bank? The buyer does not have to give money to the seller immediately. The bank
Right.
acts
Right.
as a guarantor, so the seller is not worried about it.
Right. Right.
So it
So
is a
basically,
win-win
the
for both. Yes.
yes. So basically, the money goes from the buyer to the seller through the bank.
to the bank, and for which the bank makes money out of that. And there's a huge amount of, so every corporate bank will make money because of LGs and LDs, letters of guarantee and letters of discounting.
Okay.
Okay.
So if it is a normal transaction, how does the bank exactly profit from it? I mean,
Yeah.
if if the seller has to be paid, say, rupees 1,000,
Mm. The bank will
instead of
charge a
buyer
fee.
that,
The bank will charge a fee
okay,
on
the
top of that,
fees.
right? Yeah.
Okay,
So the
okay.
bank makes money through the fees.
Okay.
Okay. And plus the what happens is the bank sets the limit with the buyer that only so much will I discount with you this year, say up to 10,000 rupees. And I
Okay.
get some fees on that. Now, if you overboard, I want
Mhm.
more, then you increase the fees because the contract was whatever and you increase the fees.
Okay.
So this is good money that you get from your customers.
Mhm.
Yeah, for corporate banking
Mhm.
or SME banking for that matter. But SME is a riskier business. Corporate banking is great business on this. It is handled by operations, and that is called, the department is called as trade finance.
Okay.
But obviously the relationship manager gets the billing. So this is bill discounting. That's how it works. So we'll come back to this problem in a minute. Let's look at these marketplace frauds. Yeah. So in this marketplace frauds, just read this and let's answer this question as to who's the fraudster, who's the victim, and what is the medium and channel in this case.
So the fraudster here are the manufacturers of the counterfeit products and the products which infringe intellectual
Mhm,
property rights. And victim is the person to whom they're selling through the e-commerce platform.
mhm.
And the e-commerce platform, such as Amazon, that is the medium and channel.
Right. So, right, in this particular case, your fraudster is obviously the seller, and the seller is the seller of counterfeit products because they are selling through Amazon. Amazon is the portal
Right,
that they are using. The
right.
victim is the customer who's buying thinking Amazon is
It is a thinking that it's a genuine
absolutely
product.
correct. Absolutely correct. Yeah. And that is what we call as marketplace fraud. So here we've looked at all this. There's another one. This is a money laundering. Here, tell me, who do you think is the fraudster, victim, medium, and channel?
Okay. Okay. So, mm, so here the fraudster uh, are the entities who were sending money out of the country.
Mm-hmm.
Victim was victim was the money were the people from whom this money was actually uh, collected.
Mm-hmm.
Could be their customers or could be someone else. And the
Mm-hmm.
medium is this particular jeweler, Chennai-based jeweler, who was
Mm-hmm.
actually helping in this money laundering through Hawala transactions.
Mm-hmm.
So fraudster were the parties who were doing the foreign remittances. Victim were the people from whom they had collected that money, could be their customers, and medium
Right.
was the jeweler about whom this article is mentioned.
Correct. Yeah. So fraudster in this particular case is obviously, your these business guys, the Mr. Madanlal Jain and the other one, Padmanabhan, both of these, because they did it through money laundering. Victim here is,
Mm,
unfortunately, for a change, it is the bank.
yes,
Okay, because they suffered losses thinking that these are genuine customers. And the medium and channel is forged bills of entry here.
yes,
Yes, those were forged, and that is a problem. So this is a money laundering case, and the earlier one is a market risk case.
mm,
Yep,
yes. This is money laundering case, right?
correct. Yeah, and through bills of entry. Bills of entry is perhaps your letters of discounting as well.
Yeah,
Yeah, because they've produced fake bills of entry. Here it is. Foreign remittances made on
yeah,
the strength of fake bills of entry. So there was no transaction, but they put together the invoice.
right, right,
Yeah. So credit loss is because of loss happening from business, and that needs to be corrected or repaired, because with that, it's going to be a problem. Yeah.
right.
So let's just come back to our case here. Just if you want, you can take a photo shot of this case. And Aniket, you're there, so both of you will do it together. So just take a picture shot of this.
Right.
And if you want, you can take a picture shot of this also, which is bill discounting. What is
Yes,
it? The concept. And we want to answer these questions. First of all, what of the four types of risks that we talked about, which are the four types of risks that are visible here?
right,
Okay. Number two, I think two and three can be combined together. How do you think what went wrong and how do you think you can overcome that? And then
right,
would rule-based or machine learning help in such a scenario?
right. Professor,
Okay.
can you please go to the case study slide?
This one?
Yes, yes. Let me take a screenshot. I think the text is not complete. It's showing.
No, it is here. It's, I don't know, there's an upgrade logo there. So it says several crores a day.
uh Okay.
Okay. There's an upgrade logo which is overriding it.
Yes.
Okay. Now we'll give you about 15 minutes to discuss this. And since we have two and we have breakout rooms, we will use that just to give it a feel. And we will come back in 15 minutes and discuss this. Yeah. Subrat, you got the link or no?
Yes, yes. I did.
Okay.
Just a minute.
So you want to join that?
Professor, due to some issue, I had to restart my system, so I got
Okay.
logged out of the breakout room. Could you please assign me back to the
Okay,
breakout?
okay, okay, okay. All right, yeah, just done that. Great. Done, guys? Okay, let's go for it. What are the four types of risks that are visible here now? You're on mute.
Yeah. One is credit risk,
Okay.
and
Aniket, can you have your camera on, please?
yeah, okay.
Okay, one is credit risk. Anything else?
And, one may be like uh, um, like false identity, for
Yes.
false company and false like that.
Mhm.
Basically credit risk and fraud risk. Both these components are involved.
Okay. Fraud risk because of the this thing. It says
Yes,
bill discounting fraud and it says money laundering in the other one, right? So
yes,
therefore,
yes,
fraud risk is very applicable, and in money laundering, we see all the three: layering, integration, and sourcing.
yes, exactly.
Right. What about credit loss?
Credit loss.
Is also there, right?
Yes, it's also
Yes,
Yes,
there.
yes.
absolutely. So you had this because of a credit loss of so much amount, 350 crores. Of course, there was a credit loss because, okay, now was the credit loss because the customer didn't pay, or was the credit loss because of fraud?
Credit loss because of fraud.
Correct. So there is no credit loss in that case. Yeah, you will mark the entire amount under fraud loss.
Okay.
Okay. And but also, will you also include operational risks here?
Operational
Yes.
risk. Yes.
Yes,
Yes, because
because
their systems did not flag the
correct.
fraudulent
Not
transaction.
one, not two, but 184 transactions.
Right.
And the amount is huge in crores of rupees.
Right.
And hence, it is so therefore we see you can say credit loss, but I would not. I would say definitely fraud and then operations leading to a credit loss. Okay. No market risks here,
Yes.
right? No market risks here. Now, what could have been done to avoid this?
More robust maker and checker system.
Mm-hmm,
Investing in better fraud detection models
mm-hmm,
and enforcing the process more stringently,
mm-hmm.
because it clearly says that the systems of the bank did not raise a flag when all of a sudden the forex transaction shot up within a month.
Correct.
So these three steps banks could
These
take.
three steps. Okay. So anything else? So where is the problem? In the process or something else?
The problem is in the process.
The problem is in the process because they had a decentralized process and they want a centralized process now.
Right,
Because both branches were there, but both branches were doing what they were doing at their own risks.
right,
And that needs to be corrected there. So again, come back to the same thing of a very weak maker checker system.
right,
And that needs to be corrected here.
right,
Yeah.
right,
And also, for example, the same thing, the variables that you want here is a strong KYC system, very strong money, aspects that they can check any of these issues. So in those years, banks were having a decentralized system. That means every branch manager would manage their own processes, and that would be not right because they had the liberty to flaw the process as well. But today, they have to be a part of the central system, so they cannot flaw the system. And hence, uh, you know, And hence it is all centralized with the back office operations to be able to, the maker checker, the maker will be in the branch, but the checker will be with the operations team, either based in the branch or in the operations department. So in some cases, to make it foolproof, branches have a branch supervisor, and that branch supervisor will ensure that while they make it, everything is good. So the first line of approval will be the branch supervisor, and then it will straight away go to the operations team to do their due diligence. So there are two checks against a maker that has been worked with. Yeah.
Yes.
Okay. And so there has to be a strong governance system. And in this case, the risk governance system. And what is the risk governance system going to do? The risk governance system is going to
They are going to assess the
prudently,
risk, yeah, assess the
yes,
risk and then implement the systems that are required to mitigate the risk.
absolutely. So they will have risk metrics that they will work on, or they will review on a regular basis to only determine that are we in the right ball game or not.
Okay. Yeah.
Okay.
Sir, I have a question.
Mm-hmm.
Like we are continuously saying that we need to assess the risk and then try to mitigate it, although we cannot eliminate it. But is there any particular like way to measure, way to quantify risk? Like
Yes.
as in how much risk should I take given my certain business size? And how much risk I should try to minimize, like whether I should do a 5% risk reduction or 6% risk
Yeah.
reduction. Is there any way to quantify?
Yeah, it is. Yeah. We will do the metrics part of it also between today and next in the next session. But the risk loss, operation risk loss has got to be less than 5%.
Okay,
So, okay, but it should always be single digit, not
okay,
not 10% and above. Yeah. The lesser the operation loss risk with operations head used to have a very stringent criteria of less than 5%, and sometimes they would say 2%. Okay, so it has to be 90% or over, between 90 to 100%. It can't be 60 or 70%.
yes, yes.
Okay.
And this operation risk loss that we're quoting in percentage, like how is it calculated? The amount lost in the risk due to,
The amount lost because of operations.
yes, divided by the total
So
revenue.
suppose I had total losses that we have made. Yeah. Now the total
Mhm.
losses that we have made, I have to articulate it or classify it as to how did I make it? Either because my expenses went up, okay, that's one area, which is the business side of it, or because of business, whatever business processes, and there comes your operation loss. So
Right,
because of business, it will be your credit loss because customers didn't
right,
pay or expenses mounted up, whatever that is. So you
right,
also now want to classify these losses based on credit loss, based on operation loss, based on fraud loss, and based on market loss also nowadays.
right,
And all this has got to be discussed by a central committee, and that is your risk management committee.
right,
Yeah. And your risk management committee has got to be therefore extremely active.
right.
It cannot be
It cannot be
just a
complacent.
puppet. It cannot be just a puppet saying, okay, do this or don't do that or whatever.
Right.
Clear? And therefore, what were the red flags that came out of this whole transaction?
Firstly, the sudden increase in forex transaction value in just one
Yes,
month,
yes,
and money getting transferred to countries which otherwise don't have a stable political situation,
correct.
and
Yeah.
the
So
system
large
not,
number of accounts opened in a very short period of time was also seen. Yeah, they opened like
yes,
184 accounts in a very short period of time.
right, right, right,
Okay. So
right.
yeah, so large period of accounts. The second one, what did you say?
Uh, Second one was transferring money to countries which otherwise don't have a stable political environment.
Yeah, so risk-based countries, yeah.
Yes.
And every month, central bank will send a list out to the banks saying these are the countries you should be careful, and these are the countries you will not do business with.
Mhm.
So
Right.
today, Russia, Ukraine has fallen in the careful zone. Few months ago, they were saying just no.
Mhm.
Okay, we will
Right.
not do business with companies who are transferring funds from your Russia to Ukraine.
Right.
Okay, and this, if when you say careful, you have to be very stringent in your paperwork, KYC. If you're not, because you
Yes.
want business, then these are the kinds of things that happen.
Right.
Okay, and in earlier days, corporates used to have their own style of pleasing the branch managers, and
Yes.
with gifts and kind and whatever, and branch managers would actually be a puppet in the hands of large corporates.
Right.
Okay. Oh, I will send you the approvals later. Can you please process it? So processes would happen not
Mhm.
in good faith, but because of monetary benefits.
Right.
Okay. And that
Right.
that all got changed in the late 2000s, early 2010, late 2000 and 8 or 9, when the crash happened globally. That's when banks globally decided in the early 2010 to centralize these operations. So branch manager was only responsible to get business. After that, the application would be submitted to a central office which was outside the branch, and they monitored it, and operations was given the strength and the power to do so.
Right.
Yeah, so that's a huge, and Bank of Baroda leads to that case study in the Indian market of the need for decentralized to centralized.
Right.
Okay, so this is also one of the classics that you look at as part of your as part of your
Right.
what should I say, enhancement in processes that you did to manage fraud and risk better.
Right.
Okay, so that was that, and so these were your huge amounts of things that you saw, which is wrong addresses, huge amounts of cash deposits, and money received from other banks transferred to overseas accounts.
Right.
So we did this. Now, credit loss. So, what are the key goals of a risk management function, and therefore for a bank is, or any organization for that matter, is minimize credit losses or reduce credit loss, reduce cost of capital, and make sure that your cost of provisioning is taken care of.
Right.
Okay, so credit loss, cost of capital, and cost of provisioning.
Right.
So this is what you have, which is impact of business. So suppose, how do you calculate credit losses? So let's look at it. So suppose you have 100 credit card customers, and these customers are spending about $10,000 every month. 95% of them are good customers, which is not what usually the bank wants, but assuming they are very good customers, which means they pay their bills on time every month. Even if it's the minimum payment, they are paying it. So it's the minimum payers and the full payers, both put together are 95%. So you get money from the 5% also, guys, who have only paid your minimum payment. Now the 5% of these are actually, that's your problematic uh, segment, because they're not paying their bills. They're not even paying their minimum payments. So if you were to calculate revenue that you receive, assuming these good customers spend about 50% on their limit, so they're spending about 5,000 US on their cards. So what are they now doing? Their bank is getting a money of 20%, assuming that's the benefit that it gets on interest rates from the 5% or minimum payers paid, whatever, 5% or minimum payment made from the 95% customers. And that is at 9.5% is what they get as income. Now, you don't take 9.5% as it is. You offset your losses against this and saying your 5% customers who are not paying their bills at all are anyways at a risk. So your net income is obviously your 4.5% and not 9.5%. And this is a healthy portfolio because we want to eliminate risks. So you are good to go as long as your good customers are able to absorb the losses from the bad customers. If they are not able to, then that's a bad portfolio. But if they are good, then that's a good portfolio. Clear? So this is how you will calculate credit losses. So this is the net income number that the risk management committee should see as one of the metrics. What is our credit loss in terms of net income or a net loss? If it's a net loss, it's a problem, which means we are giving credit more to bad customer profile than to good customer profile. We need to change our strategy. Okay, but if we are, as long as we are good to go, no questions asked, we'll go ahead because we are doing business with these risky customers, but their income is getting offset with the good customers.
Sir, I have a question. So the bank basically earns interest when like typically a credit card has a certain interest-free period.
Correct.
So if a customer is paying within that period, bank doesn't earn anything.
Bank just
earns
earns
only,
from the merchant, that 2.5%.
okay,
Yeah,
two and a half percent.
which normally the merchant absorbs and does not pass it on to the customer. Remember, sometimes the merchants say if you use a credit card, you'll have to pay a 2% fee. So they
Processing fee,
charge you, they charge you to pay to the bank. Otherwise, they absorb it.
right?
Okay, so that's one, which is why the banks want their point of sales terminals at the retail outlet.
Right, right,
Okay, so
right.
that's yeah.
Yeah.
And
Yes, because I'm trying to understand the calculation which is shown here, 95% into 20% into 50%. So
right,
95% customers, basically the bank
are
doesn't,
are
uh,
are your good customers here,
yes, who
and they
pay
are
their credit card bills on time,
including minimum payment.
minimum payment, right?
Yeah, because minimum payment are also now there are two groups here. One is who pay in full, one is who pay in part.
Mm-hmm,
And the third group is one who do only the minimum payment.
mm-hmm,
Okay, so those are your group of customers. So it earns interest rates on them, assuming 20% on the minimum payers and the part payers.
mm-hmm. Okay,
Because on the balance there are finance charges, right?
right.
So that is the income that we're talking about. So 20% of 95% customers, and they are spending 50% of the credit limit only. Assumption, yeah. It could vary, but we are taking a standard average of 50%.
Okay,
And that's how we get a 9.5. Now, average 50% is on the lower side. Usually the average is about 70% or so, yeah. Because nowadays people are using a lot of their credit limits. Okay, that's why sometimes people have to adjust their limits, and banks give them that facility to adjust their limits on a daily basis. Clear, Shubhrat? So two types of credit risk we have. One is the operational credit risk and the other one is the regulatory credit risk. What do we mean by regulatory credit risk?
so basically regulatory risk is the risk at overall like broader uh, level of the portfolio instead of customer level.
Mhm. So regulatory risk is analysis of credit loss at the segment
But
level,
yes,
or the portfolio level. If you find issues at the portfolio level, you drill down to the customer level.
Right.
Otherwise, it is not good. I mean, that is the problem here. Yeah.
Right.
So what is the problem here? If your portfolio is good to go, it's okay, perfect. Because within that, there will be individual issues also, which is great. And that's why you have to eliminate risks. No, you have to minimize risks.
Right.
But so what gets reported to the central bank also is the portfolio level. So as long as the portfolio is healthy, it's great. Nobody analyzes it at the customer level. Only
Right.
if you find issues at the portfolio level, will you drill down at the customer level. So when the
Right.
customer level is huge, yeah, suppose your regulate portfolio level is showing a huge loss amount, and that is wanting you to look at the individual level. Many a times, what you do is what you do is you do a haircut solution. What do you mean by haircut solution? You write off the losses at the customer level and you make it healthy.
Okay.
Okay. Because if
Okay.
you can't collect, if there's a difficulty, whatever it is, you want to get your books healthy because there is an IPO coming or there is a investor coming, then you do a heck, or when there is an acquisition also.
Okay. Okay.
Okay.
But if the bank is writing off the loan of customers, then won't it affect their revenues eventually? I mean,
Yes, their
they're
revenues, but
paying it out of their provisioning amount which they have kept for
correct.
provisioning.
Correct. So therefore, they will start on a clean slate, right? So if it's a merger or an acquisition, the acquisition firm, the firm who's acquiring, does not have to bear these losses.
Okay. Okay. So
And
basically,
the
they will not
value,
acquire the debts.
no, they will let it lay off, and the merger price will be also be in their favor, right?
Mm-hmm. Right.
So that is, so they will let them do the write-off and then take the firm. If you want to have a
Right.
new management, same story. All write off with you. Now we'll start fresh.
Right.
So that's when, if it is huge, it's not a good practice, but it's a great practice in these things. We see a lot of haircut treatment being allocated. If you keep on allocating, same management will not do that because it's going to reflect bad on them, their dividends, their profits.
Right.
Okay. So, but everything has to happen. So if your individual level customer is going wrong, and if it is reflected at the portfolio level, change your strategy. Don't go after risky portfolios.
Right.
Okay. So if, for example, the defaulter segment of 20 to 24 younger age group is increasing, your policy will change for that month saying, don't give credit to these customer groups.
Right.
So two types of risks we have is expected loss and unexpected loss at the operational, at the regulatory level, which is at the portfolio level. So this, as a great example, was this bank did two things very well. They managed their loan to deposit ratio and they did pre-provisioning. What does pre-provisioning mean? That the moment the sale is booked or the customer is booked, you will have an estimate on them whether you will have an estimate of them as to whether you should, what is the probability that this customer will honor the payments. If the customer is going to honor the payments, then yes, it is a great and a wonderful relationship. But if not, then it's going to be a issue. So you make the provision for them today. Okay.
Right.
And then you have the other one, which is loan to deposit ratio. Now, what is loan to deposit ratio? Loan is
Loan to deposit ratio is like how much loan they have taken to how much loan they have returned.
correct. So no, from the deposits that the bank receives, suppose the bank receives 100 deposits, that's the denominator.
Mm-hmm.
How much loan have you given from them, from that?
Mm-hmm.
Okay. So from the deposits of 100, how much loan have you given?
Right.
Correct. And what do you think should be the ratio? It can't be 100%. Yeah. It can't be
Right.
1.
Right.
So what should it be?
It should be
It should be closer to 100.
closer to 100, right?
Yeah. So, but not at 60 also. 60 is which means you're managing your funds very badly.
Okay. So this is the loan to deposit ratio that we are discussing. A
Correct.
loan to deposit ratio should be close to 100.
Yeah, close to 100. So anywhere between 95 to 100 is a good ratio, but not 100, not 99. So ideally, a good ratio is about 94 to 97%.
Okay. Okay.
Okay, which means you're keeping some funds aside in case somebody wants to cancel their deposit. If it's a corporate deposit, if they want to cancel it, you must have funds ready. Individuals also. So if you're making a withdrawal of more than a certain amount in the Indian banking system, I think more than whatever 2 lakhs or 3 lakhs, you have to give prior intimation to the bank so that they will have it ready.
Okay. Okay.
And that's
So
how they will
when
have
we
it
when we
ready.
say deposit in a loan to deposit ratio, it is the the
Customer
values.
deposits.
Yes, that is a term deposits that the bank keep.
All deposits, current account, savings account, and fixed deposits.
Okay.
Okay. And therefore, in current account, you or in savings account, so you get an interest, but there's no
Mhm.
lock-in period. In a fixed
Right.
deposit, there's a lock-in period, which is why if you break the deposit before time, you have to pay a fee because the bank
Right.
also has to
Penalty
get
fees.
their funds arranged.
Right.
Yeah. Because how is the bank giving money on loans from the deposits that it receives? That's how it makes money.
Right.
Okay. And therefore, loan to deposit ratio is very, very an important KPI to look at the risk management. So the credit committee or the risk management committee will look at number one, credit loss, net
Right.
loss or net gain. Second, they will look at the health of the portfolio at the regulatory level, at the segment level. And third, they will also look at something which is very strong, and that is the loan to deposit ratio.
Right.
Okay.
Right.
Yeah. Just 1 second, yeah, guys, just 1 minute. So guys, just to recap on what have we done so far, so then we can move ahead. And what we talked about is the types of risks: credit risk, market risk, fraud risk, and obviously operation risk. And it's very important that we manage these risks very well, because if we are able to manage these risks very well, obviously we should be able to minimize our losses in the accounts of our bank. uh, Always look at segment level and not at the customer level.
Right.
Some of the KPIs that the risk management committee will look as obviously the net profit or loss, net income or loss from the good to the bad customers, the health of the segment, and lastly, it will also look at things like what is the loan to deposit ratio at the segment level.
Right.
Okay. So you have three kinds of losses: expected loss, unexpected loss, and the loss because of the market economy. So what is an expected loss? Expected loss is a loss that occurs because of the
That,
way you give business,
yes.
the way you give business. Unexpected losses are losses that you've given the business, you expected the customer to pay, but there's a problem that has happened. And so unexpected losses and market economy losses together, are kind of overlapping nowadays, because unexpected losses are a lot occurring because of losses of wrong estimation of market transactions or market movements as well. So your regulatory credit risk is an expected loss, and that, how do you calculate it? You calculate it based on probability of loss. You calculate it on expected loss, which is your exposure at loss, and the last one is your loss given default. So you multiply all of that. In the unexpected loss, it is the same thing except that you have something called as an asset correlation. Now, what do you mean by asset correlation? Businesses give money to various functions or departments. Suppose I have given to the hotel industry, and during COVID times, if I have loaned money to hotels, they were not able to pay. Now, in that year, if I have given money to the healthcare sector is doing very well, and the money from the healthcare sector is able to offset the loss in the hotel sector. But if I'm giving money to the hotel sector and the aviation sector, I'm not able to do that because both sectors are going at a loss. So the asset correlation basically is the contributor to unexpected losses because of a misalignment, or because of not a risk prudent strategy that you took as part of your loans and advances that you gave to the sectors. So your portfolio, again, it is at the portfolio level that you want to look at, and not look at the portfolio level, and not look at the customer level. Yeah.
Right.
So in this particular case, let's look at a little bit on the macroeconomic impact. So suppose you have these three segment of customers: the highly affluent, the customer with no income, and a middle class customer. So which of these three segments do you think are most likely to be impacted by recession? So you're analyzing these three segments now. You have a highly affluent segment. You have a customer segment who lost their jobs and they have no income for the moment, and you have a middle class customer. So which is going to be your this one? Which is going to be your most vulnerable segments?
Uh, Actually, we cannot say solely on the basis of their income levels, but assuming that other factors remaining constant, the the one with no income will be
Okay.
most affected.
Okay. With no income will be most affected. Okay. Aniket, you have a thought?
Yeah. Because highly affluent customer can also impact due to the economic condition. Maybe his income may reduce, and for middle class also there will be impact because there will be no salary hike, or there will be no maybe he maybe get laid off during those conditions.
A no customer, oh sorry, a person with no income will always be at risk, right?
Yes.
Right.
Affluent customer, hardly at risk. So it is the middle class customer which you need to look at in this particular condition. If you want to study and on priority basis, study the impact of market risks on the middle class segment first. Because they are the most vulnerable. Even if they have income, how are they going to meet their loan payments or credit card payments with you needs to be understood. So do you have risk mitigation measures for economic environments? And the answer is yes. The methods are survival analysis, dual time dynamics, and obviously study of the macroeconomic environment. So your survival analysis is basically, can I stay put by not receiving anything till this event occurs? In the sense, if I finish with this recession boom or recession period for the next 3 months, if this person does not pay, is it still going to be good to me for the overall operations that I run? Dual time dynamics is basically for till the time the loan is going to get matured, say 2 months or 20 months or whatever, can I expect this person to pay later on, if not now? And sometimes you also extend it to say, can I write it off now? Yeah, if the person is supposed to pay $100 in the next 4 months, can I get $80 now rather than spending money on collection agents and trying to get it at the maturity date? Or if the person is on a loan holiday for 2 months, can this person then make payment for the balance? So here you're talking about, uh, you know, uh, till the time of the payment, what is early settlement a better option, or is waiver for 2 months a better option, or is just continuing with the same relationship a better option? And that's what you do as dual time dynamics. Survival is just, can I stay put in this time period? And you also do log out curves here. Log out curves means, is my good portfolio able to absorb the losses that I'm making from the bad customers due to market risks? And this, of course, comes through your intuitiveness rather than with data. And that years of intuitiveness is nothing else but your experience.
Right.
So nowadays, organizations are looking at not just macroeconomic, but macro environmental factors which are impacting businesses and the way you want to give money in loans. Earlier, this was not a problem, but today it is a big problem because your macroeconomic factors do impact the way you give loans. Yeah. This was quite an interesting video. Why? Because McKinsey is known for us to be a strategy firm. Now, if McKinsey is known to be a strategy firm, McKinsey is now saying that we also do risk analytics, and it is quite surprising for its clients. So it is now talking about why risk analytics is very important in strategy. Let's look at that.
It's estimated that the world produces 2.5 exabytes of data every day. In the past 2 years, we've created more information than in the rest of human history. Businesses are rushing to use advanced analytics to more accurately assess and price their risks, mitigate unwanted risk exposures, and tailor their strategies to achieve extraordinary risk-adjusted performance. In this area, McKinsey brings our clients a distinctive value proposition. We combine our expertise in risk analytics with deep experience and understanding of the business context at hand. The results provide significant and lasting impact in business performance. For example, stress testing is an area we've had great impact. In the United States, we've helped numerous banks' forecasting approaches through the development of revenue, expense, and loss forecasting models. We're now extending this expertise to new markets where banks are facing increasing regulatory pressures to conduct more extensive stress testing. Stress testing analytics also supports the strategy behind large capital-intensive projects. We've worked with several mining and energy clients whose projects are capital-intensive and especially sensitive to commodity prices. We've built models for banks, insurance companies, and others to predict credit risks, improve loan monitoring, fraud detection, and collections. In an Asian bank, our efforts led to a 30% lower loan origination cost and a 50% reduction in both turnaround time and overall losses. McKinsey is also at the forefront of model validation and model risk management. Our recent acquisition of Risk Dynamics, a leading risk analytics firm, further bolsters our abilities in this burgeoning area. Banks, insurers, and asset management companies have long relied on statistical techniques to rate borrowers. Today, we can complement traditional analytics with new techniques, such as machine learning, to find previously unidentified patterns to help clients make more accurate predictions. At a European car insurer, 40% of all fraudulent drivers were classified within the 20% of drivers that our algorithms classified as high risk. We've helped a Latin American telecommunications provider enhance their collections process and identify the 15% of customers causing 83% of losses. Models built purely on statistical knowledge can result in a wonderful correlation that's just plain wrong. Numerous models cluster customers into risk segments based purely on statistics. The question is, how should a business approach these different segments? Our business knowledge allows us to build meaning into these segments, providing new insights into how to manage the risks of these segments more effectively. We believe that risk-advanced analytics are the next frontier in risk management, using the data revolution to better predict, monitor, and mitigate risks. Because after all, it's not the data, it's what you do with it.
Yeah, any key thoughts, guys, on it?
So basically, they are McKinsey's into developing the risk prediction models, which they are claiming is helping multiple organizations to optimize their risk exposure.
Correct. And therefore,
minimizing possible losses due to credit risk, or fraud risk, or operational risk, or even macroeconomic risk.
mhm. So risk, and so again, reinforces the point that risk and strategy building are very, very common methods of how things are going to work for the organization or a bank in our particular case to be able to manage risks very, very prudently. Yeah. So this is another classic case study, guys, on Wells Fargo Bank. So when Wells Fargo says that we manage employee attrition very well, and of course it was known for the wrong reasons again during the pandemic. This was quite a interesting article that I got hold of, and just read it and firstly tell me, from the four risks that you see: market, credit, market credit fraud, and lastly, operations. Which risks are visible here? And secondly, what do you think is the main problem here? Just your thoughts on it. What kind of risks are visible here, and what is the main problem here? I will not put you into breakout room. In this time, let's do it. Just discuss it amongst yourselves, and then we'll discuss it together.
Sir, I just have one question. It's
Yes.
written here low to mid-teen percentages. Mid-teen percentages as in?
Absolutely teen, yeah, which is 13 to 19.
Okay.
So when you say
And-
mid-teen is 15%.
Okay. Okay.
Okay.
Okay. Okay. So, talking about risk, here we are seeing market-related risk because due to pandemic, the businesses to whom Wells Fargo had lent money on loan, they were suffering commercial losses. So it's related to market-related risk. And basically, it's more around market-related risk and not estimating the market risk properly.
Okay. So this is a clear, is it only market risk? So this is a clear risk-based assessment that they have to do. Is it only market risks?
Market risk and credit risk as well.
Credit risk class. Yes.
Okay. Market risk and credit risk. Any fraud risk here?
Giving wrong projections, maybe yes, that could be. But it's basically mistake in giving the projections. It doesn't involve the money falling into wrong channel or the wrong person. So will it be actually considered as a fraud risk?
Okay. Will it? I mean,
Uh,
are any of those 4 types of frauds visible here?
no, I don't think so.
No, right?
No. No, I think it's only credit risk and market related risk.
So this is talking about Q1, right? When
Yes.
is this being talked about? In Q1 or Q1 has already happened, which is now you're in Q2? When are you talking
Q2.
about this thing? You're in
Q2.
Q2, which means
Yes.
Q1 has already happened, and that
Yes.
thing they did it, they projected it badly.
Yes.
Now, because they say pandemic, we are assuming this to be 2020.
Yes.
Since the pandemic, yeah. So Q1 and therefore Q2. That's the time period we are assuming. So what are the
Right.
2 losses that they have made? They have made 6.4 billion
Commercial losses.
commercial losses because of commercial loans. When you say commercial loans, these are corporates, primarily SMEs. Correct?
Correct.
And why did they make this loss?
They made this loss because of dip in the business, leading to reduction in the revenues.
Yeah, because they invested in oil and gas, right? And they invested in
Real estate.
real estate here. This one also, commercial loans.
Yes.
Okay. And because they invested in real estate and oil and gas, they suffered this much of a loss. So now what are they projecting for Q2? They are projecting that this, prices are going to fall by about 15%, low to mid-teens, so about 12 to 15 or whatever, 13 to 15% in the future. So they're saying commercial estate prices will fall and therefore they have to be more prudent. They have not said we will stop do business with these sectors, right?
Right.
So
And basically, they're revising their estimates.
their strategy. So
Yes.
they, based on the strategy, are they saying we continue to give commercial loans?
No, they're not saying that they will stop giving commercial loans, but they will revise the strategy based on the reevaluation of the value of certain industries,
Correct.
like real
So
estate and oil and gas.
commercial loans will continue.
Right.
Right. Now, what is the issue? I would say there is only market risks here.
Right.
Did the customer default on payment?
The customer, mm, it's not mentioned whether they defaulted or not, but if if the businesses are making losses, they are most likely to default, if not now, in future.
Correct. So basically, what are they saying? They are not defaulting because they are not in a condition to pay.
Right.
They
Due
are
to market
defaulting
condition.
because of market conditions, and therefore
Right.
there is no credit loss here.
Right.
Is there a fraud loss? No, there is no
No
fraud done
fraud
at
has been
all.
committed. Yes.
Correct. Is there an operation loss? No, there is no system issues.
Right.
So this is 6.4 can clearly be attributed to market risks.
Right. Exactly.
And nobody knew what was happening in Q1, whether the pandemic is going to stay or to go or what, and everybody was suffering, including Wells Fargo. So one can clearly park 6.4 billion as a market risk.
Right.
Right. Now let's see what happens afterwards. Now just read what what the CEO Charlie is saying. So same question, what is the time period of this statement? Q3, right?
Right.
Because they're saying it's in our second quarter. So second quarter has already happened and now they are in Q3, Q 2020. So Q1 market risk. And what was the loss amount? The loss amount was 6.4 billion.
Right.
Q2 loss amount is 8.4 billion.
Right.
So loss to date
8.8
is about 14.8 billion, right? So why is this Q2 loss happened?
Because of unfavorable market conditions, market not correcting
Look
itself.
what they said. They said credit loss. In the earlier one, they said, would you agree with what they said as credit loss, or would you still park it under market risks? Or would you say credit risk now?
And now it's a credit risk.
Now it's a credit risk. And why is that so? Because
the companies to whom they had lent the commercial loans, they were unable to repay it.
okay.
Probably that is the reason why the CEO is categorizing it as a credit loss.
So what did they do in the first period? They're saying our assumptions were wrong.
Right.
So they did not stop, they continued, and they continued throughout Q2. By the end of March, the world knew that this is going to stay here. It's not a short-term phenomena. And there were
Right.
lockdowns everywhere. But these guys continued with the assumptions when that assumption should have changed. So they
Right.
continue to give loan to commercial establishments in spite of the fact that they knew that they will not be able to pay back. And they did not pay back, and that is the credit loss. So it's not a market risk condition. In the second quarter, it becomes a credit loss condition.
Right.
And this is because of credit loss first, and then a little bit of market risk you can put, but primarily because of credit loss. And that has cost the bank a lot. So because of your poor assumptions and your policies, you suffered a higher loss in Q2. You were not prudent enough. You should have avoided giving loans at least in the third month of the second quarter.
Right.
You did not. You continued with your assumptions, and that was a problem. There was lack of agility. There was lack of aligning your strategy or policies with the environment.
Okay. Basically, they did not revise their strategy
After the second quarter also, and now also they're not revising it. They're just making a statement, not saying anything about the third quarter.
Right.
Yeah. So, and plus their asset correlation, the R was very low because they were investing in commercial estate, which was going through a loss, and they were investing in oil and gas, which was also going through a loss. So that one was contributing to the loss and not saving, and therefore unexpected losses occurred in addition to market risks.
Right.
Clear?
Clear. So basically, they expected the market to recover after the first quarter, but it didn't recover, which led to credit loss.
Correct. And that was adding more to the losses that they made.
Right. Right.
Yeah.
Right.
So any questions on this?
So, like in this particular case, what Wells Fargo could have done better in order to be in a better position?
They should align their they should align their policies more frequently to the market conditions than otherwise. So if they said it will be mid-teens in the quarter, as you get more information, pause on that. Don't continue to ramp up your business the way you were doing earlier.
Okay. Okay.
Okay.
Right.
Now there's a small exercise that we will do, and then we can, if there's nothing else, then we can wrap up, but just this one. So, just this is a case where we'll want to look at reject inferences. So there are 4 group of customers, which is applications, A, B, C, and D segments. A segment, B segment, C segment, and D segment. Okay, now in the first segment, the entire data is available with the bank for demographic data, behavioral data, target variable data, and the target variable exists. What is the target variable? Anybody wants to tell me what is it?
Target variable,
Is fraud management.
yes, whether it's a fraud or not.
Not what. So in first case, everything is available. In the second and third applicants, you in the B segment, you have demographic data, but you don't have behavioral data. You're getting it from the credit bureau. And based on that, you're creating a target variable.
Right.
Yeah. In the C, you don't have anything. You are getting credit bureau data, but before 2017.
Right.
And in D, you don't have anything, but you're creating a target variable based on the behavior of segment A, B, and C, and you're overlapping that on segment D.
Right.
Okay. Now, these are the treatments that you give typically: test and learn, downstream bureau data, and parceling and augmentation. So test and learn is successful if the bank has enough budget and a good culture. Downstream bureau data is successful if rejects were approved elsewhere or in the past. And parsing and augmentation is build a model on past approvals and apply model on past rejects.
Okay. So, I couldn't understand what is meant by test and learn and downstream.
Test and learn is you have enough budget and a good culture that you have the data with yourself.
Mm-hmm.
Okay.
Okay.
Downstream is you don't have it, but you're getting it from somewhere else here,
Right.
elsewhere, or you have had it in the past, but not currently.
Okay.
And parsing and augmentation is build a model on past approvals and apply models on past. So everything based on past behavior is what you use for projecting in the future.
Okay. Okay. So based on what the kind of cases that were approved in the past, future approvals are decided.
Yes.
Okay.
Okay. So I want you to tell me what were the reject inferences that were used for A segment, B segment, C segment, and D segment. Okay, what are the reject inferences used for these 4 segments? And you want to take a picture of this because this I can keep it on. Or you can take a picture of this also if you want.
Okay. So when we say reject inferences, that means the kind of criteria which was used to approve or reject
Yes,
particular
correct,
cases.
correct, 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 correct. Yeah.
Okay.
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 So you want me to keep this on or you've taken a picture?
No, I
Or
haven't taken the
okay.
picture.
You want me to keep this on as a slide?
Yes.
Yes, sir.
Okay.
Yes.
And this one you can take the picture.
Right.
Okay.
Right.
Now, what I
So,
will do, guys, is just a minute. I'll play this back on. What I would do is I will give you a 8-minute break, very quick one, and then I will ask you to do this in 10 minutes. Then we will come and wrap this up with an answer, and we will close. So I'm going to give you a total of about 20 minutes with your, break time if you want to look at it. But I want you to consider this, and we'll then discuss it, and then we'll close our session today.
sure. Yeah.
So I will play this, yeah. As in, I will show this. Okay. You wanted this on, right?
Yes.
Okay, good. So just be there. Take your, I will be back in about 20 minutes, yeah?
Okay. Okay.
Okay, sir.
Okay, all right. All right, guys, sorry, let's quickly finish this off.